Today, we're breaking down DBO, the Invesco DB Oil Fund, an ETF designed to give investors exposure to crude oil using futures contracts rather than holding physical oil. Unlike traditional stock ETFs that hold shares of companies, DBO tracks an index made up of WTI crude oil futures, allowing investors to gain exposure to oil prices without trading futures themselves. What makes DBO different from many competing oil ETFs is the strategy it uses to select which futures contracts to hold. Most oil ETFs simply buy the front-month contract and roll it forward each month. But that approach can create problems when the futures curve is in Contango, meaning longer-dated futures contracts are priced higher than near-term contracts. When that happens, the fund is forced to sell cheaper expiring contracts and buy more expensive ones during the roll process. Over time, this creates negative roll yield, which can slowly erode returns even if oil prices remain stable. DBO attempts to reduce this problem by using what it calls a next-generation futures strategy. Instead of automatically rolling into the nearest contract, the fund evaluates the shape of the futures curve and selects whichever contract month within the next 13 months looks most attractive according to its index rules. By rolling into contracts further out on the curve when conditions warrant, the strategy aims to minimize the impact of Contango and potentially improve performance compared with oil ETFs that follow a simple front-month rolling strategy. However, investors should still understand that futures-based commodity ETFs can behave differently from the actual spot price of oil. Even with optimized contract selection, returns can diverge depending on the structure of the futures curve, market volatility, and the timing of contract rolls. Another important consideration is the fund's tax structure. DBO is organized as a commodity pool, meaning investors receive a K-1 tax form instead of the standard 1099 typically associated with stock ETFs. Gains are taxed under the 60-40 rule, where 60% of gains are treated as long-term capital gains and 40% as short-term gains regardless of how long the investment is held. The fund and its underlying index are rebalanced and reconstituted annually in November, allowing the strategy to adjust its contract selection as market conditions evolve. Because of its optimized futures approach, DBO is often used by investors looking for direct exposure to oil prices, portfolio diversification, or a tactical way to express a view on the energy market without trading futures directly. And that's the Invesco DB Oil Fund, ticker DBO. An oil ETF designed to track crude oil futures while attempting to reduce the negative impact of Contango through optimized contract selection. If you found this breakdown helpful, make sure to like, subscribe, and follow the ETF Investor for more ETF analysis and fund deep dives.